Invest in what you know, right? Well, for most of us who live in the United States, such a well-trodden investment maxim probably doesn't make a whole lot of practical sense in terms of buying and holding a portfolio of stocks that can help you build wealth over a lifetime. With us today is Mitchell Firestein, a portfolio manager at Avantis Investors. He has researched the long-term benefits of diversifying a portfolio of stock and bonds across different markets, both domestically as well as throughout Europe. Hi, Mitchell. Thanks for joining us today.
Great to be here.
Over the years, some people have developed certain opinions about investing overseas. You've described these as investment myths. Please explain.
Yeah, so this is a general question that we get actually quite a bit about for US investors, why they should even be interested in investing in the non-US space. And it's a question that we receive quite often. If you focus just on US equities and you ignore international markets, an investor is only investing in about 60% of the total market capitalization of the world. There's still another.
Mitch, why do they ask that? Is that because they're performance chasing?
Yeah, so if you look at the last decade, so if you look at the 2010s, for instance, the US market generally outperformed the non-US developed markets. So there is a little bit of that where they're looking at past performance and trying to project that on future performance, which is always a very dangerous game to play.
Sure. So, so you advise people, and your lineup is domestic as well as international.
Absolutely, and this is important. So, as I mentioned before, if you're just focusing on U.S. securities, you're only investing in about 60% of the total market capitalization of the world. There's still another 40% out there. So this introduces opportunity costs to an investor as they don't have exposure to these companies with their own distinct cash flows that might outperform in the future. So just as you diversify sectors in your US allocations, the size of securities, be it large caps or small caps or styles, value stocks, growth stocks, high profitable stocks, et cetera, you also want diversification of countries.
And global diversification, you've taken a look back at all the figures, and it shows that while one part of the world might be going down, another is likely to be going up. Sometimes they're both going down, sometimes they're both going up, but it diversifies portfolio and actually lowers the volatility level by diversifying globally, correct?
That's exactly right. And that's why it's so important to build a global diversified portfolio. So if you look at the best performing country to the worst performing country in the developed market space, which includes the United States, in the last 20 years, the spread between the best and the worst is about 40% per year. So there's a wide variation. So if you hold the country with the worst performing, you're putting all your eggs in that one basket. Instead, you can spread across you can diversify across geography, and then you can lower your volatility. Why? Because countries aren't perfectly correlated with each other. There's different cash flows coming in at different times by these companies.
Okay, and you also have pointed to a second myth that U.S. markets offer more than enough diversification.
Yeah, that's exactly right. So, as I said, you're leaving behind a huge portion of the investments behind by not investing internationally. And these, as I just mentioned, they have their own distinct cash flows to them that are not necessarily associated with what's happening in the U.S. So you want exposure to those companies as well in your portfolio to help smooth the ride over the long term. Diversification is a friend to investors.
And there's also a trap known as home bias. Could you talk a little bit about that?
Yeah. So home bias just means that you are overweight or you have only exposure to your home country. So if you're a US investor, that means only investing in the United States. So while there are some advantages of potentially being slightly overweight, having a slight home bias, This typically has to do with taxes and costs associated with trading international stocks. It's still beneficial to have some allocation to those international stocks because you do want to have that diversification. So uh, when times might be bad for the U.S., it's offset by international stocks, just like we saw in the 2000s. So if you go back in time a little bit, go back a decade or two, in the 2000s, non-US stocks outperformed their US stock counterparts by quite a bit. And so if you didn't have any exposure, if you only had US stocks, you would have underperformed in that. You probably would have underperformed in that period.
Third myth that you've addressed in the past is currency is all that matters for determining non-US market returns
Yeah.
for US investors. Myth?
Yeah, so this is a common one where people are trying to play international equities by saying the dollar is going to strengthen or weaken, and why it can add a little bit of tailwind to it. When you strip out the volatility of currencies, it doesn't add that much. The volatility is really swamped by the equity volatility, not the currency exposure volatility. What I mean by that is if you invest in an international stock, if you invest in a stock in the United Kingdom, that security is purchased in pounds. Well, if the dollar weakens and the pound strengthens, that helps your return as a US investor. And the vice versa is true. But really, what's driving the returns is the equity performance, not as much the currency performance.
You don't play the hedging game with your funds, correct?
That's exactly right. We don't. And the reason for that is the volatility, the amount of volatility of international stocks is really due to the equity component, not the currency component that you have in the international securities. And that's been shown through long periods of time where you can actually decouple the equity volatility from the currency component. It's also very expensive to hedge currencies, which would also add cost to the investor.
Okay. Well, thank you very much for your time today.
My pleasure. Great to be with you.